All right, everybody, give me a second here. Okay, so thank you for joining the Wealth Building Secrets for Real Estate Investors. We will now begin the conference. Um, I am going to be your special guest today, and my name is Abero Koye. I am a CPA and an active real estate investor and the founder of Wealth Building CPA. I own real estate investments in 5 states across the Eastern Coast. I've helped companies and people such as yourself both preparing their taxes online and offline. And my greatest joy comes from helping clients such as you become free of financial stress. What is the wealth building CPA advantage? I've been in the industry for so many years, so I'm very familiar with money saving strategies, which I love to implement all of the time, combined with my 18 years experience as a CPA tax strategist and 11 years experience as a real estate investor and business owner. With this combination, it's usually a great pleasure for me to empower you to make your financial life so much more profitable. What this means for you is that you can trust us as one of your team members so that you can spend more time and your money in your business. And I will introduce to you the Bencho team. This is Tom and Amy, TJ, Jen and Thomas, and Betsy. I'm the owners of Aurora Real Estate Investment Group. And what is the Aurora Advantage? Aurora Real Estate Services is a family owned and operated business. They provide hands off real estate investment opportunities just for you. They have built a proven system that takes all the guesswork out of real estate investing. And they help you locate undervalued properties, perform cash flow analysis, determine the cost of renovations and estimates and after repair value. They renovate the property and facilitate property management. And they also list the property if you decide that you don't want to keep the property but want to sell it. May I also pause here to mention that one of the states that I do invest in is in Pennsylvania and also specifically in Pittsburgh. Pittsburgh is definitely a great area for buy and hold. TJ, do you want to chip in? Do you want to say something before I move on?
Yes, I want to thank you very much, Bear, for teaming up with me on this particular webinar. I enjoy our working relationship, and just wanted to agree with a few of the things you said. At Aurora Real Estate Investment Services, we have we've been investing in Pittsburgh real estate since 1925. We own over 70 of our own investment units and have 100 out-of-state investors. And our goals are in line with the Bears as far as allowing you to be free of financial stress. And allowing your time to be free. Bear and I are in the same mind frame on that, which allows us to take you in the same direction.
Great. All right, so we will go ahead and get started. There are 3 walls of defense that you need against IRS. As everybody knows, IRS audits are on the rise for real estate investors. And this year, they came out with a new rule that if you have a regular job but are involved in real estate, you are a target for audit. They found out that most of the errors that are made on tax returns come from real estate investors who also have a full-time job. So if you meet that criteria, you need to be aware that the IRS is targeting you for an audit. They just passed that law. I think it was in March of this year when it came on my desk. So that's something that you need to be aware of, that it's possible that you will be going through an audit in the next, 1 to 3 years. And so you need to build up your defense against the IRS to make sure that even if you were to go through an audit, that you are going to come out with a clean bill. The first wall of defense against the IRS is audit prevention, meaning you don't even want to get audited in the first place. There are several things that you can do to ensure that you do not get audited. The first thing is to incorporate. If you're currently running your business as a sole proprietorship, and you are filing a Schedule C, that is screaming for an audit. So you definitely want to go ahead and separate your business from yourself. You don't want to commingle because you don't want the IRS to think that you are running a hobby. By having, when you have a sole proprietorship and you're filing a Schedule C, the IRS really doesn't take you as a serious business owner. And so they tend to audit Schedule Cs and Schedule Es a lot more than all the other tax returns. So the first step in audit prevention is to incorporate. Don't run your real estate business with just a sole proprietorship. The next wall of defense is automatic pre-audit preparation. This is something that you want to have in place before you even start preparing your return, such as good record keeping, um, separate bank account, a separate EIN number, not commingling, not taking funds from your business and using it for personal expenses, or paying for business expenses from your personal bank account. So automatic pre-audit preparation really comes with record keeping. How do you keep your records? Keep your records in such a way where there's a clear line of distinction between your business and you as an individual. If you have superior record keeping, 99% of the time you are going to do well in an audit. Most of my clients that I've represented in audits and they did not make the audit is because they did not have proper records. If the IRS is asking you for backup, um, if the IRS is asking you for backup and you're not able to provide that, then that becomes a problem. Um, so that's one thing that you definitely need to work on. The third step is advanced tax planning before December 31st. I train my clients to realize that April 15th is actually the tax filing deadline. It's not a tax saving deadline. So you definitely one of the things that you want to do is to look at your tax return in November, December, not April, because in April, if you're coming to me to get your taxes done, we're just reporting what happened. That doesn't give me enough time to do any planning. So I teach my clients that December 31st is really your tax savings deadline. As a real estate investor, you want to have advanced tax planning, meaning you take a look at your tax picture, your financial situation, what has happened from January up to November, whenever you're getting the tax planning done, and see if there are things that you can put in place before the year runs out. Because once December 31st has come and gone, there's really nothing that you can do. And usually we're able to find out, things that we can do before the year runs out that can also, help against an audit. For example, if you have a single member LLC, but then you have all these education expense for real estate, it would make sense that you probably consider converting to a multi-member LLC. If you generated income as a wholesaler or you did a rehabbing and generated income that's subject to self-employment tax, one of the things that we can do before December 31st is to file an election so that your LLC will be taxed as an S corp. So just little things like that we do before December 31st can help to raise your wall of defense against the IRS. There are three factors to consider in choosing an entity. Um, the first one is ease of compliance. I usually hear people talking about choosing the right entity structure, but they're only looking at it from the legal perspective. But there's three perspectives that you need to look at: the ease of compliance, tax liability reduction, and asset protection. So what this means is that when choosing the entity, you don't just want to look at the legal aspect. Is your entity structure going to result in more liability or less liability? What's the ease of compliance? Meaning, do you when you have a C corp, then you have to deal with shareholders meetings, board of directors meetings. You have to keep minutes. There's annual filings that you have to do. So you want to look at the ease of compliance. Tax liability reduction, not all entities are created equal. when it comes to tax liability reduction. For example, the example that I just gave with somebody that's a rehab or a wholesaler. Well, one of the things you're worried about is self employment tax. It's not the same thing that a buy and hold investor is going to be worried about. A buy and hold investor would be more worried about passive losses and being able to deduct those passive losses. So the entity structure that you choose should also take into account the tax impact of your real estate strategy. And then, of course, the third thing is asset protection. You definitely want to look at a tax structure that protects you. As we all know, most of the single member LLCs in most states give very little protection. So one of the things, the goal is to find one that meets all three criteria. And I usually advise my clients that one size does not fit all, and structures can be changed. You don't have to stick with a structure simply because you registered it. It's possible that if you registered a structure today, you can always change it tomorrow to fit where your business is. Just like you go to the doctor every year, you want to do your entity structuring analysis every year. And my overall advice is to start with your real estate strategy and then find a structure that fits that strategy. Because we need to think about things like an umbrella insurance, maybe getting a multi member LLC, setting up your operating agreements. All of that, when I work with my clients, I take all three into consideration, not just one aspect of it. The next item that we're going to look at is how an LLC or a corporation that owns real estate is taxed. This is something that's very important because usually I just got off the phone with a client that told me that they formed a corporation to do real estate. I mean, it's great because that's what the lawyer told them, that gives them the best asset protection, but then they're going to be hit pretty big when it comes time for taxes. So it's understanding how these different entities are taxed, and that would help you in your tax planning. An LLC is taxed as a disregarded entity, meaning that when it's time to pay taxes, the IRS does not look to the member of the LLC, does not look to the LLC, but looks to the member of the LLC. So it's called a flow through or a disregarded entity. So whether you have a single member LLC or a multi member LLC, you will be taxed based on your individual tax rate. If you have a multi member LLC or even a single member LLC that is classed as an S Corp, you would get a K1 from the LLC and file it on your individual tax return. I cannot tell you how many clients have come to me during tax time and feel that maybe the LLC is going to be paying its own taxes separately, so they went ahead and got their own returns done, only to find out later on, no, you need to get a K1 from that LLC to include on your individual tax return. How is a corporation taxed? A corporation is taxed as a completely separate entity, meaning if a corporation generates $50,000 of income, it is going to be taxed on $50,000 of income. That corporation pays the taxes. It does not flow through to the individual member. It does not flow through to the shareholders. And this is something that's very important to note because if you're just starting out in real estate and you have expenses, that means that if you formed a corporation but you have expenses in the first year, guess what? Those expenses will not reduce the income that you have from other sources like your regular job and all that. And so that's why it's very careful if you want to use a corporation for your real estate. That's, there really has to be an overriding reason why you do that. Usually corporations don't work for real estate investments. How's a sole proprietor taxed? Pretty much the same as an LLC. The only difference is that it's not filing a separate tax return. You file, you are taxed at the individual member's tax rate. Which state to form an entity? I know we answered this question before the call started. I've heard people say, I want to form in Delaware, Wyoming, and I put in there Mars, Jupiter. It doesn't really matter. One of the things that I um, tell clients is that the local laws govern the legal cases. So if you're going to form an entity in the state where your property is located. It doesn't make sense that you form an entity in Delaware, but your property is not located in North Carolina. Well, if ever there's a legal issue, it's not the Delaware laws. It's going to be the local laws, you know. Foreign entities will still need to register in the state where the property is located, so that even if you registered in Delaware, you will still need to have that Delaware LLC become a foreign entity in North Carolina where the property is located. So at the end of the day, you still would have to have some type of relationship with the state where the property is located. So usually I suggest that you form an entity in the state where the property is located. All right, business entity structuring and formation. Most people want to know, why do I need to incorporate? One of the major reasons, which is something that I alluded to before this call, you want to incorporate because you have a higher chance of being audited if you file an individual business tax schedule, which is a Schedule C or a Schedule E. I mean, these are studies that we've done over the years, and we've come to see that usually when people are getting audited, you hardly hear that somebody's getting audited because they have a partnership tax return. Not that it doesn't happen, but it's like a 99% to 1 chances in terms of a Schedule C. So the reason why we usually suggest that you incorporate is because there's a higher chance of being audited if you don't. How do you open an LLC or how do you register a business? I'll just go through the simple steps of what you need to do. The first thing is that you need to get your articles of organization ready and submit to the State Department. Once the State Department approves of your article, you would get an EIN number from the IRS. With that EIN number and the acceptance of filing from the state, you would open up a business bank account. And then the next step is you want to draft a comprehensive operating agreement with all the tax reduction and asset protection provisions, including charging orders, buy-sell provisions, reimbursable expense. I cannot overemphasize how important it is that every investor that owns a business needs to have a comprehensive operating agreement, especially if you have an LLC. Even though it's not a public document, it's a document that you keep with you. But for IRS purposes and even for legal, if you ever get into a legal battle, you definitely want to have a comprehensive operating agreement because that's what the IRS is going to be looking at in terms of deciding what to do with that business. So I see a lot of people where they get the articles of organization and they think that that's it, or they get an EIN number and that's it. No, you definitely need to take the next step and draft a comprehensive operating agreement. After that, you also discuss your bookkeeping process. Once you open up your business bank account, you have the operating agreement. You definitely want to get the bookkeeping process started because you don't want to commingle your funds. You want your business account and your business expenses and income to be completely separate from you as an individual. And then, of course, I've noted here that you want to do a yearly review. Always review this every year. Make sure you're in compliance. I cannot tell you how many clients have come into my office and told me that they had an LLC only to go to the State Department website and realize that the LLC has been forfeited because they did not pay the annual filing fee. There is a fee that you need to pay every year to keep your business in good standing. The final thing that I wanted to talk about is I want you to see your real estate as a business. The goal of every business is to make money, not to spend money. So if you see your real estate as a business, it kind of changes your mentality in terms of the way that you do things. You want to plan and budget strategically. And when I say budget strategically, I'm saying make sure that you are spending money for which you are going to see a return. If you're going to take a real estate course, if you're going to get a coach, if you're going to invest in a property, don't just do it for the emotions of it or because you've heard somebody say at a boot camp, hey, invest in this course. Do it because it's going to give you a return on investment. You also want to look at time management. That's a very critical issue because if you have a regular job and you are looking at investing in in real estate, then you definitely want to plan your time very well. Is real estate going to need 10 hours a week from you, 20 hours? You need to do time management. Life planning, when I look at life planning is really looking at, where your family situation is. Are you single? Are you married? Do you have kids? Do you have other things, health issues that are going on, and plan your real estate around that. You definitely want to set up an alternative board which is called your power team. Most of the time, real estate investors are a one man shop. You're wearing all the hats. You're the CEO, the CFO, the money person, the decision maker, the administrative person. And sometimes it's difficult for you to take an objective look at the business. So you want to set up an alternative board, which is your power team, to help you look at your business critically. And then finally, you want an integrated approach to wealth building. When I talk about an integrated approach, you want to look at all aspects of wealth building. One of the reasons why people spend a lot of money, get bad advice, or don't end up achieving their real estate goals is because they have all these different members of the power team saying different things to them. A lawyer will tell you to get a C Corp. And then another investor will tell you to get an LLC. And then maybe your tax person will tell you to form an S Corp. It's not integrated. You want an integrated approach to wealth building where everything is looked at from one perspective. Um, Here, I'm going to note what the ultimate wealth building plan is. The Ultimate Wealth Building Plan, this is a program that actually came from my clients, where, we found out that, I prepare their taxes, I help them from their entities, I do the business registration, and we realized that the unique thing that the Wealth Building CPA brings to the table is that we provide an integrated approach to wealth building, meaning we're able to look at all aspects and make sure that all the team players are talking to each other. So if you want to have the ultimate wealth building plan, these are the stages that you need to have. I'm going to go through them pretty quickly, but I advise, if you want more information, just to visit wealthbuildingcpa.com slash the ultimate wealth building plan after this presentation to get a more comprehensive look at what a wealth building plan is. Stage one, you need to do a financial needs analysis. We need to determine where you're going and where your goal is. And then we need to do tax planning and preparation. Make sure you're up to date with all your tax filings and also do tax planning to reduce your taxes. We need to look at your entity structure and get the businesses formed that need to or restructure the entities that need to be restructured. Register the business, set up your bookkeeping, do your business analysis meeting, which is where the CFO and the alternative board comes in. Investment property purchasing at this step is where we would help you purchase your properties, which we're going to be going into in the next section about how to purchase properties under market value. And then we also look at retirement planning and finally year-end tax planning. Like I said, for more information, please visit the Wealth Building CPA at the Ultimate Wealth Building Plan after this presentation to get more information about the Ultimate Wealth Building Plan. At this point, I am going to go ahead and hand over to TJ.
Thanks, Aber. Aber, I just want to thank you for all that wonderful information. No matter how many times I hear you present it, I always gain something new from your presentation, and there's so much valuable information in there. I just want to highlight a few of the things that you said that I think are so important as a real estate investor, that myself and my family own over 70 investment units of our own, and we've been investing since 1925. One of the most beneficial features of what a bear does is she allows you to look forward and not look backwards what I mean by that is she allows you to be proactive and not reactive. When you have all your finances, especially in the real estate world, there gets to be a lot. When you have them all in front of you and you're able to project what the next best step for you is, rather than getting the tax time and react on that, you're in a much stronger position. Wouldn't you agree, Aber?
Yes, definitely.
And the other one of the other points that I really liked was start with your real estate strategy in mind, then find a structure that fits that strategy. A lot of people want to just pick a structure and then try to throw any type of strategy into that structure. And that also goes in line a little bit with what we do. A lot of people go to real estate investment meetings and they hear about these different investment strategies, and they choose one that they think they like, and then they try to fit their life into it. We believe that the best way to work is to determine where you're looking to go in your real estate investing career and choose the investment strategy that goes along with that. Most investors that I speak to are seeking financial freedom. That means they would like to not have to worry about getting up and going to work their 9 to 5 eventually. And the main way to get there is through buy and hold properties, to be a landlord, to be a real estate investor that holds properties. And the reason being is buy and hold properties provide passive income. They provide a rental check every single month, whereas other type of investments require you to continuously flip properties or wholesale properties to keep making more money. It's like another 9 to 5. I'm not against them. I do them all. I think you have to integrate all strategies, as you said, Aber. But I think the base of my personal real estate investing strategy is the buy and hold strategy. And Pittsburgh, PA allows for high cash-on-cash returns due to several reasons. It has a lower cost of entry than most cities in the United States, mixed with a very strong economy, which we will go over in a moment. Also combined with low tax rates and very friendly, very landlord-friendly tenant-landlord laws. So to touch base on what supports the Pittsburgh, PA real estate investment market. I can throw a lot of stats at you. I can speak from my own experience, which I will do, but I want to let the national media speak a little bit first. I'm not going to go over every bullet point, but starting back in 2007, we started to receive a lot of national media to back the economy in Pittsburgh, and especially when the market crashed. A lot of other areas in the world experienced huge downturns. Well, Pittsburgh's real estate only went down 2% in property values during the market crash. You had areas like, Vegas and California and Florida experienced property devaluation of as upwards of 30, 40, 50%. And when people started to realize that they wanted long-term wealth, and that comes through stability, Pittsburgh has become a much more attractive market. So you can see back in September of 2009, Business Week ranked Pittsburgh the 6th strongest housing market in the U.S. It's a very prestigious company, writer, Business Week, and to rank Pittsburgh the number 6 strongest housing market in the U.S. really says something. Moody's in December 2009 ranked Pittsburgh among the top 5 markets expected to fare best in 2010, and we lived up to that. You could go down and you could see in January of 2010, Zillow.com ranks Pittsburgh the best city in America to buy foreclosed homes. And then I love this one, of course. In March of 2010, Forbes.com ranks Pittsburgh the number 1 most livable city in America. The number 1 most livable city in America. The reason behind that ranking is, and it continues today, is our unemployment rate is about 2% below the national average. Our crime rate is about 1.5% below the national average. We have 15 Fortune 500 companies headquartered in Pittsburgh. You could see in June of 2010, Bloomberg Businessweek ranked Pittsburgh the number 4 most improved housing market. Just another backing to what we have going on. Albert, if we can move on to the next slide, please.